Representing ICICI Securities, it's our absolute pleasure to host the very first results call of Go Fashion India Limited after the listing. The company is represented today by Mr. Gautam Sarogi, Chief Executive Officer, and Mr. R. Mohan, Chief Financial Officer. Over to Gautam for the opening remarks, and post which we'll open up for Q&A. Thank you.
Good afternoon. A very warm welcome to everyone present on the call. I hope you are keeping safe and healthy during this time. I would like to thank the entire investor community for the tremendous support during our IPO in November 2021. It was a proud moment for all of us. Along with me, I have Mr. R. Mohan, our Chief Financial Officer, and SGA, our Investor Relations Advisor. Hope you all have received our investor deck by now. For those who have not, you can view it on the stock exchange and the company website. Since our company has just been listed and we are doing the earnings call for the first time, I would like to share a brief overview about our company and the growth path ahead. Go Fashion India Limited is a women's bottom wear brand in India with a market share of approximately 8% in the branded women's wear space. We are engaged in the development, design, sourcing, marketing, and retailing a range of women's bottom wear products under the brand Go Colors. The women's clothing market in India has evolved in the past decade from the traditional one-piece apparel like a sari to a two-piece mix and match apparel, with bottom wear becoming an essential category that caters to basic and functional needs of consumers. Today, bottom wear has become a must-have that provides comfort as well as style, and it's a round-the-year universal category that is not subjected to seasonal trends. We are among the few apparel companies in India who have identified the market opportunity in women's bottom wear and have acted as a category creator for bottom wear. We were the first company to launch a brand exclusively dedicated to women's bottom wear category and have leveraged the advantage to create a direct-to-consumer brand with a diversified and differentiated product portfolio of premium quality products at competitive prices. We offered one of the widest portfolio of bottom wear products among women's apparel retailers in India in terms of colors and styles. Our bottom wear product, which includes chudidar, leggings, dhoti, harem pants, patiala, palazzos, culottes, pants, trousers, and jeggings, are sold across multiple categories such as ethnic wear, western wear, fusion wear, athleisure, denim, plus size, and girls, making our product portfolio universal for every occasion. We sell bottom wear in over 50 styles and in more than 120 colors. We design our products to cater to women across all age groups and girls and fits that are suitable to various body types and physiques. We endeavor to provide our customers with premium quality products at a price range that caters to all income segments, and the price range of our product ranges from 249 to 1,599, which, while our average selling price of our products at EBOs for the 9 months fiscal year 22 is rupees 659. These factors, coupled with the lack of seasonality, ensure that our product portfolio is resistant to redundancy from fashion trends. The strength of our Go Colors brand and round-the-year relevance of our product portfolio allows us to typically retail our products at full price. Our full price sales for 9 months fiscal year 22 was around 97%. We serve our customers primarily through our extensive network of 476 EBOs, operated primarily through a company-owned, company-operated model that are spread across 23 states and union territories in India. Our cluster-based approach to opening and operating EBOs allows us to pursue the COCO model, which results in better operational control and greater store profitability. In our experience, retailing through EBO caters better brand recall. Our EBOs are located in high streets, malls, residential markets, in major metros, large cities, and tier 2, tier 3, and at airports. In addition, our distribution channels include large format stores including Reliance Retail Limited, Central, Unlimited, Globus, and Spencer Retail, among others. We operate 2,330 large format stores as on 31st December 2021. In addition, we sell our products through our website and online marketplaces and other multi-brand outlets. Our in-house design and merchandising team designs and develops bottom wear products across categories with their deep understanding of consumer requirements, in-depth market research, and data analytics, helping in creating the fit and comfort of our products. The efforts of our design and merchandising team are supplemented by our extensive sourcing network and manufacturing network undertaken through 733 suppliers, 42 job workers across 11 states and union territories. We have strategically undertaken brand building initiatives to gain visibility with prudent use of resources while incurring limited branding and marketing expenses. We retail our products under a single brand for improved brand recall and better marketing of a product, which has yielded one of the highest revenues per unit spent in the industry. We have a strong unit economics with an efficient operating model. We have a standardized and scalable developed model of our EBOs based on our know-how and experience. In determining our store rollout, we assess optimum store size and layout and lease agreements that are typically long-term in nature and revenue share agreements. Our ability to identify and determine the optimum location and size of the store, as well as manage rental costs and marketing leverage of our EBOs, are critical to ensure visibility among target customers and sustainability of store profitability, resulting in our company having one of the highest sales per square feet among key women apparel companies. Our unit economics has allowed us to expand our EBO network across various regions in India, including new EBOs in Tier 1, Tier 2, Tier 3, Tier 4 cities and towns. Our product being core and essential to customers has enabled us to operate a business model where we offer limited discounts and sale of a product is typically at full price, which on experience results in greater profitability. We staff our EBOs with limited people per store, which is among the factors that contribute to our store profitability while ensuring adequate attention to customers. In addition, our EBO's average selling price has increased continuously, primarily on account of value-added products, including pants, trousers, and plus-size products that we have introduced in our product portfolio. During the last quarter, we launched 3 new winter wear bottom wears such as suede trekking, corduroy jeggings, and warm kurti pants. We have an extensive procurement base with a highly efficient and technology-driven supply chain management. We manage our inventory and logistics as well as our entire supply chain of our channels from our 99,100 square feet warehouse in Tirupur, Tamil Nadu, and which is capable of handling complex SKU mix. We have automated our entire procurement and supply chain through our ERP system, which allows us to maintain flexibility and enables to meet our requirement in an efficient manner without relying on any one vendor, supplier, or factory. Our ERP system enables us to streamline our procurement needs, including the quantity required, and enabling us to avoid over or understocking, as well as handling complex SKU to meet our supply chain requirements of our extensive distribution network. Our inventory management ensures that we are able to maintain inventory levels across our wide range of SKUs and our distribution network. As part of our inventory management, we also track business intelligence reports generated by our system to address changing trends and customer preferences, which would result in minimal write-offs. Now, coming to our company strategies, we continue to expand retail networks with a focus on EBOs. As part of our growth strategy, we intend to expand our EBO network in other regions across India. We plan to expand by 120 to 130 EBOs every year. We intend to follow the FOCO model that will ensure better operational control over our stores. Given our cluster-based approach of establishing EBOs primarily in Tier 1 cities, we will also focus on establishing additional EBOs on a similar model across Tier 2, Tier 3, and Tier 4. We expect to leverage our existing extensive store network and our ability to expand our store network in particular EBOs to tap this growth opportunity. This could allow us to maintain the quality of our operation while also improving the visibility of our brand and a standardized customer experience. We intend to leverage the experience of our operations and business development teams to grow our network in existing and newer geographies. Our expansion in newer markets offers us potential for market share gains, increased brand recognition, and economics of scale. We will also look at selectively expand our presence across large format stores as our large format stores grow their presence in India. During the last quarter, the company has added 19 EBOs, and during the 9 months, the company has added about 38 EBOs. 11 stores have been shut down during the year due to COVID-related impact. In the coming quarter, we expect to add approximately 25 additional EBOs. On an average, one EBO would require an investment of 35 lakhs Indian rupees with an average payback period of 15 to 18 months. With increased focus on EBOs, we expect increased cash flow generation through increasing revenues from EBOs and reduced debtor days and reduced working capital requirements. This will lead to a healthy and sustainable business model, increased profitability, and better return ratios in the future. One of our important channels are online channels. The growth through online channels. E-retail in India has witnessed rapid growth in the last few years. Sales for online channels for Go Fashion is rupees 9.25 crores in 9 months for fiscal 22, which is 3.24% of our sales. It has grown at a CAGR of more than 72% from 9 months December 19 is compared to 9 months December 21. We continue to focus on further strengthening our online sales to benefit from evolving customer trends in our market. We propose to make investments in digital channels to build an omni-channel engagement experience for our customers and have a dedicated team for our e-commerce operations. We also intend to leverage our existing capabilities to increase our online presence by improving and upgrading our website. Our focus is to target customer acquisition to drive sales through our website and online marketplaces. In addition, we intend to invest in content generation to build engagement with the younger audience. We will continue to focus on analytic technologies to create personalized journeys for our customers. Through these measures, we aim to expand revenue-generating channels as well as become a digitally relevant brand for Indian women in the bottom wear segment. Leverage technology to bring cost efficiency and enhance customer experience. We intend to further improve our operating efficiency and ensure efficient supply chain management through global best practices. Among the measures that we intend to undertake, investing further in our infrastructure to improve productivity and time saving. We will look to upgrade our warehouse to optimize our inventory and supply chain. We intend to implement new technologies to further expand and improve customer delivery and enhance customer buying experience with faster dispatches. We intend to also undertake data analytics that will allow us to understand better and customer preferences, including sales, and help scale our operations. With this, I would like to hand over the call to our Chief Financial Officer, Mr. R. Mohan, for the update on Q3 and 9 months fiscal year 22 financials.
Please give me a moment, sir. The line of Mr. R. Mohan is disconnected. I'm calling him back.
Hello. Hello. Yeah.
Mr. R. Mohan, please go ahead.
Hello.
Mr. R. Mohan, we can hear you. Please go
Hello, it got cut. Hello.
Just a moment, sir. Let
Hello.
me just check.
Hello.
Yeah, we can hear you.
Hello.
Just give me a moment. I'm disconnecting his line and calling him back. Mr. R. Mohan is connected. Please go ahead, sir.
Hello. Hello.
We can hear you, sir.
Thank you. Sorry for the disturbances on incoming call. Thank you, Gautam, and good afternoon, everyone. Sorry for my interruption on the call. The company has posted a strong performance for the quarter 3 and 9 months ended 31st December 2021, backed by the increased demand across product categories. Our revenues for the quarter stood at 142 crores as against 97 crores in Q3 FY21, registering a growth of 47% year-on-year. This growth was led by a strong demand across our product portfolio. Our EBITDA for the quarter stood at 52 crores, registering a growth of 72% year-on-year as compared to 30 crores in Q3 FY21. Our EBITDA margin, which stood at 36.7%, have seen an improvement of 540 basis points on a year-on-year basis. Profit before tax for the quarter stood at 33 crores, a 95% year-on-year growth from Q3 FY21. Profit after tax for the quarter stood at 24 crores, a 33% year-on-year growth from Q3 FY21. Profits have been lower due to increased tax payout during the quarter. Coming to same-store sales growth, we have seen a 43% SSSG if compared to Q3 FY21, that is last year, and an SSSG of 10% if compared to Q3 FY20, that is a pre-pandemic period. Coming to a 9-month FY22 financials, our revenue stood at 284 crores as against 161 crores in 9 months FY21, registering a growth of 77% year-on-year. This is not a comparable growth due to a high impact of COVID in last year. Our EBITDA for the 9 months stood at 81% as compared to 22% in 9 months FY21. Our EBITDA margins, which stood at 28.5%. Profit before tax for the 9 months stood at 33 crores, whereas profit after tax for the 9 months stood at 23 crores. SSSG for 9 months is not comparable due to COVID-related lockdowns during the last financial years. With this, we'll open our floor for the question and answer. Thank you.
Thank you very much. So we'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Arpit Shah from Stallion Asset. Please go ahead.
Yeah, I just want to understand what are the unit economics, how the unit economics are different from an LFS sale and from an EBO sale.
Yeah, hi Arpit. I'll take a question. Thank you for joining the call. See, in EBO, our margins are higher because we are selling to customers directly on full price. Whereas when we are selling to a large format store, we have channel margins which are part of the revenues. So usually for us in the EBO channel, we require an average investment of about 35 lakhs, including inventory, to put up a store, and we are able to get the payback period in about 15 to 18 months on an average. In a large format store, we usually have a 40 to 45% channel margin which we are giving to the LFS partner. So when we compare EBO and LFS from an operating margin perspective, the operating margin of LFS would be half of what an EBO would be in terms of profitability. But in terms of working capital days, EBO is a much lighter model compared to the LFS because the stock what we have in large format stores are on SOR basis, and that is one of the reasons why our receivable days is on the higher side.
Got it. And typically your share will be missing, like going towards EBOs, right? 2-3 years down the line, the share of EBOs will increase more than the LFS.
Yeah, so Arpit, what we are planning to do is, currently our EBO contributes to about 72% of our business. Our immediate plan is to increase it to 80% in the next few years. So we are able to sell to our customers directly. We have a control of our channel. This way, this will also show an improvement in gross margins and the profitability of the company as well, and in reach and expansion.
And what would the online strategy? Currently the sale is 2.5% from the online part. Would that increase to 10, 12, 13% in the next 1 or 2 years?
Yeah. So online is a very, very important channel for us, and that's one of the reasons why even we are implementing an omni-channel strategy, which is under development right now. We are upgrading and building a new website. So our idea right now is which our sales are coming from 2 to 3% from the online business. We want to take it to double digits in the next few years. Online is going to become a very, very important channel in collaboration with our EBOs to customers.
Okay. And just one last question. I just wanted to understand how are you keeping in turn with fashion? Like, leggings was a big thing a couple of years back. Largos are right now the big thing. How are you going to keep up with the fashion trends in the women's bottom aspect?
Yeah. Thanks. So I'll tell you, we have a very, very data analytics approach to this business. See, though we are in a core product, on a long-term horizon basis, very rightly you mentioned, products do keep changing. Sometimes leggings are going to be in fashion. Tomorrow it might be some other product. So our data analytics of sales helps us to understand the life cycle of a product in terms of sales. So whenever we see a product on a long-term horizon basis dipping and we see another product sales increasing, automatically our inventory management at the back end changes. Over and above our data analytics and business intelligence, we also have a very experienced team of in-house designers who study the entire retail market and women's apparel market, and we kind of come out with new products every year to stay relevant in this category.
Good. So typically you don't have any inventory risk, right?
Ideally we don't have any inventory risk. Absolutely. Because most of our colors and products are round the year products and go year after year without going out of fashion.
So your inventory days typically should reduce if you keep increasing the data analytics.
Absolutely. See, unfortunately because of COVID, our inventory days became a little on the higher side. Historically, our inventory days used to be between 90 and 100 days. Our endeavor is to bring it back into that range in the future.
Anything below that?
Sorry?
Any number below 90 to 100 days?
No, definitely. See, our first target is to get to 90 to 100 days back to our old number. And then as efficiencies keep coming in and we keep increasing our data analytics, we keep optimizing inventory quarter on quarter.
This is not typically a fast fashion, right?
This is not fast fashion. Yes.
Okay. Yeah. Thank you so much.
Yeah, thank you.
Thank you. The next question is from the line of Vicky Punjabi from JM Financial. Please go ahead.
Hi, sir. Thanks for taking my question. Just wanted to understand a few things here. One was, I believe you've shown that the revenue versus, the SSG versus, say, December 19 quarter was somewhere around 10.5%. I just wanted to understand if we had to compare the revenue versus the December 19 quarter, what was the growth there? And just an extension to this is, I understand the business is completely a core-driven business, but is there any seasonality between quarters for this business, which kind of makes revenue, say, in a December quarter better than what we would achieve, say, in a March quarter or something like that?
Yeah, sir, thanks, Vicky. Thanks for your question. Very well you pointed out. So the same-store sales growth for our stores has been very encouraging. It has been 10.5% when I compare to pre-COVID levels. If I look at it at an EBO channel level, we have grown at an overall EBO channel level, we have grown at 29% compared to pre-COVID quarter 3. And at a company level, we have grown at around 27%. So this 29 and 10.5 delta, so 18.5% has obviously come from newer avenues of new store expansion. Now, as far as seasonality in sales are concerned, though we don't have seasonality in our product, yes, we have seasonality in sales and concern. But for a brand like us, the seasonality is not too much. Yes, quarter 3 definitely is one of the stronger quarters because of festive and better shopping mindset of the customers. But for us, the fall in sales between individual quarters is not very large because of our being a core and round the year product. Quarter 3 being the strongest, even if we go to the next quarter, there will not be a very sharp fall in sales because ours is a daily wear essential for the daily customer.
Sure, sir. Just an extension to that, is there any impact that you're seeing from the third wave right now?
Yeah. So Vicky, yes, the Omicron variant which has come in and the January sales have taken a hit. There's no doubt about it. But the good thing is now the lockdowns all have been removed by January end. And in February, we are seeing all our stores functioning in full swing like before. So we are very, very hopeful and bullish on the sales coming back in February and March strongly.
Sure, sir. Okay, I mean, that's it. I just had one housekeeping question. Can you also help us understand what was the EBITDA margin for 3Q on a pre-Ind AS basis?
Yeah, pre-Ind AS basis, our EBITDA margins would be about 24 to 25%.
Okay. Thanks a lot for that, sir. That's it from my side.
Sure. Yeah, sure.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, thanks for the opportunity. My first question pertains to terms of trade in LFS. You briefly spoke about it while answering the first question, but if you can explain a bit, how do we account for SOR in our books and a bit more in detail and how margins are recorded in our books?
Yeah, sure, Tejas. Thank you. So Tejas, the sale what we do with the large format stores is really on a principal to principal basis, right? And when it's in a principal to principal basis, the ownership of the goods shift to the large format stores when we dispatch the goods to their respective stores. So when we dispatch the goods to their respective stores, we have to account it as a sale in our books because of this principal to principal relationship. So in accounting, we have to book it as a sale and it shows as debtors in our books. Now, we realize the money only when they sell further. So when they sell further is when we get payment for that. Now, revenue recognition, so ideally a channel margin of a particular LFS would be around 40 to 45%. So, for example, if the MRP of a product is 100 rupees, just for conversation's sake, it's 100 rupees. So, and if the channel margin of LFS is 40%, I would be recognizing 60 rupees as revenue in my book and will show debtors in my book. So, when LFS sells it further, then is when I get the 60 rupees back into my system as a payment. So, this inventory what is there at the large format store is debtors in my book until I realize the payment. And as far as profitability is concerned, it is about, in terms of what kind of EBITDA we generate from our EBO level, it is half of the profitability of what an EBO would be on MRP.
But that's largely because your denominator in LFS is lower by it is net of trade margin, right? Otherwise, ideally it should be higher in EBO versus LFS.
No, that's what I'm saying. The EBO is, the LFS is half of the EBO profitability. The EBO is higher than EBO. Correct.
Okay.
That's what I said.
Okay, sorry. That's good. That's clear now. Second, you just spoke about while answering the previous question, you spoke about there's no seasonality in our business in terms of volatility in revenue, and the fact that we don't have any EOSS pressure because of the kind of product and brand positioning that we have. So is it correct that even profitability is not very much driven quarter on quarter, and this is slightly a new business for us to understand, so that's why pardon my ignorance on asking a basic question here.
No, of course, Tejas, I'm happy to answer. So see, Tejas, one of the most important things in our business is our full price sales. See, ours is a core product. Our product does not go out of fashion. When a product does not go out of fashion, there are limited discounts what we offer. So historically, even pre-COVID, we had more than 95% of our sales coming on full price. Even in fiscal year 22 for the 9 months, we have reached a situation where more than 97% of our sales are coming on full price. When as a brand we are able to command more than 97% on full price, automatically that reflects in very strong gross margins and very strong EBITDA margins. So the fluctuations in gross margin, EBITDA margins, and PAT margins would be negligible quarter on quarter because of our full price mechanism.
Sure. And just one bookkeeping question. What was our first 6-month profit or loss for FY22?
Yeah. So for the first 6 months we have broken even at a PAT level, almost broken even. And in quarter 3 we have generated 23.6 crores of PAT.
And this was largely because of the second wave, or?
It was largely because of second wave. So our first quarter we had a loss of about 17-18 crores, and which was primarily due to because of the second wave lockdown.
Okay. So barring this exigencies, we should not have this kind of volatility number for the factors that you just mentioned in detail.
Yes, absolutely.
Okay. That's all from my side. I'll come back and give some more questions. Thanks a lot and all the best.
Thank you. Yeah.
Thank you. The next question is from the line of Aniket Sethi from ICICI Securities. Please go ahead.
Hi, Gautam. On the gross margin bit, you did mention that EBO expansion will kind of lead to a better gross margin profile. But could you also discuss the product mix angle over here, for gross margin? Basically the growth in the non-leggings part of the business.
Sure, Aniket. Thank you. So, Aniket, see, we as a company, our gross margin for all our products, whether it is legging or whether it is a trouser, whether it is a palazzo, is very consistent. See, we don't want to charge higher multiples on our new products because we want to keep the product as affordable as possible. See, our company motto is very premium, high quality garments at affordable prices, at the right pricing. So our multipliers and gross margins from product to product is very similar. So it does not really differ. But in terms of a mix perspective, today 50% of our sales comes from the leggings and chudidars, which are our core products, and the balance 50% comes from the other value-added products like trousers, harem, patialas, palazzos, etc.
And in this, if you could how has the share trended over the past, and how much do you expect it to be in the next 2-3 years?
So see, earlier, historically, yes, leggings and chudidar was a much larger market. It used to occupy 2/3 of the business. But today, with how westernization has come in India, the sale of the other products have increased. Though we have actually seen an increase in volume for the leggings and chudidar, but its contribution has reduced to about half of the business now.
Okay. And this half is on a value basis or on a volume basis?
Both are similar. There's no real big disparity for us between volume and value.
No, because the new products, the assumption would be at a slightly higher price points, right?
Yeah. So it will be more or less in the same range. It won't differ too much.
Understood. Second, the outlook of adding 120 to 130 stores for the next 2-3 years. So how many new cities are you looking to enter in the next 2 to 3 years? And if you could also break this expansion in terms of your south and west versus northeast, where you are relatively less present.
Yeah, sure, Aniket. So, Aniket, see, we follow very unique model of expansion. We follow the cluster-based expansion model. See, for us, rather than spreading ourselves thin, we like to go deep in one territory and open more number of stores. So, for example, if you see the 476 stores, about 58% of the stores come from the top 8 cities. So, and even in these top 8 cities right now, we feel there's a lot of scope of expansion. So, from an expansion perspective, we are going to continue growing into the cities where we are present, especially the top 8 cities, because we feel the scope is going to be very large. But at the same time, we are also going to enter new cities. So, our idea is to enter in about 8 to 10 new cities every year. So it's going to be continued expansion in tier 1, tier 2, but with also equal important focus on tier 3 and tier 4.
Understood. And lastly, on the anything you're looking at the large format stores as a key growth driver, or that should be kind of the share should keep on coming down going forward.
See, large format stores is definitely going to be a key driver for us. And you look, large format stores have increased year on year. If I compare to fiscal year 21, we have grown at 30% from fiscal year 21. So it's going to be a very, very important growth driver, because what large format store does is, Aniket, it gives us access into newer cities. It gives us the experience of that particular new city before we can open an EBO. So a large format store is a very, very important channel for newer geography expansion. Having said that, our EBO expansion is going to outgrow our LFS expansion. So LFS would continue to grow at a same store sales growth level and a new store expansion level, but the EBO is going to outgrow it. And that's why we see the share of EBO increasing in the business and LFS reducing as a percentage.
Understood. That's very helpful. Thanks, Gautam. Thanks, and wish you all the best.
Yeah, thank you, Aniket.
Thank you. The next question is from the line of Akshay Thakkar from Fidelity International. Please go ahead.
Congratulations, teams, on a very good set of numbers. I had two set of questions. One was around the GST rate change. So that was introduced and then rolled back. So could you just talk to what was the pricing action that you had to take, and did you reverse it and stuff like that? And the second question was around the margin structure. If you look at gross margins at this level, are pretty healthy. If we are to roll forward 18, 24 months, do we see scope for expanding gross margins from this level, or we are satisfied with gross margins? So I'm just trying to understand, if EBITDA margins have to move up from here, will it be driven more from gross margins or from operating leverage? Those two questions from my side. Thank you.
Sure. Thank you, Akshay. So as far as GST is concerned, so we were, the government had come out with a notification that it's going to become 12% from January 1st, and it got deferred. And see, we as a company and we as an industry, I would in fact talk on behalf of the industry. We are hopeful and quite positive that it will stay at 5%. See, because if that happens, I think, there would be a situation where brands might have to increase their selling price. And so from that perspective, we are quite positive and hopeful that, such increase in percentage should not happen. As far as we are concerned, we did take a price hike a few months back because of the cost of raw materials going up. See, the cost of raw materials as far as yarn fabric is concerned has increased over last 24 months in a very huge way. It's increased more than 40-50%. So we did take a price hike, and so that was last when we had taken a price hike. And as far as GST is concerned, we are very hopeful that it stays at 5% and does not increase to 12 in the coming quarters or months. As far as margins are concerned, so this increase in margins is obviously because of the EBO sales mix increasing. So today we are delivering a 60% gross margin because of a large business coming from EBO. As our EBO business keeps increasing as a percentage, we are wanting to increase it to 80% in the next few years or next 8 quarters. So with the road of it going from 72 to 80%, the gross margins will automatically keep increasing. And as the gross margin keeps increasing, we will see an upside in the EBITDA and PAT margins as well. But having said that, keeping the gross margins increase aside, even as our company revenue grows more and more, there are many fixed costs of the company which will also further optimize. So there's going to be an upside on the EBITDA, not only from a gross margin perspective, but also in terms of operating efficiencies.
Just a quick follow-up. So even if I adjust for seasonality in Q3, which obviously might have had some benefit on margins, and then I add the two drivers that you mentioned, that EBO going up leads to better gross margins and operating leverage that you should see given the kind of store additions that you will have, should then mean that a high 30s or early 40s type of margin should be doable. I'm not saying next year, but let's say in a journey of 3 to 4 years. That's not inconceivable, right?
See, currently our EBITDA margins are about 36%, Akshay. So I think there will be an increase in those EBITDA margins as our gross margins and company revenues.
Okay, sure. Thanks so much, and all the best to the team.
Thank you, Akshay.
Thank you. The next question is from the line of Mayank Gank from TCS. Please go ahead.
Sure. Thanks. So, sir, till 2018, I observed in the balance sheet of the company that the company's asset turnover ratio was approximately 7:1. That is, with a fixed asset of 26 crores, we were able to clock 189 crores of sales. And the same store sales growth was somewhere around 18,000 rupees per square feet, which post-pandemic we were badly hit. Since then, I noticed that the company has increased the fixed asset by 10 times. That is, it is currently at 280 crores. Assuming that there is no lockdown this year, do you think we can regain the same level of efficiency in terms of asset turnover ratio and SSG? And if yes, can we extrapolate this to revenue?
So in this, there is a very big impact of Ind AS 116. What happens in Ind AS 116 is these rentals are all amortized in the book. So your fixed assets, which is showing at 280 crores, which would be much higher because of this notional Ind AS 116 entry. So our asset turnover ratio has really not changed over the last few years. It's just that because of Ind AS 116, the number looks very large in the balance sheet. As far as future is concerned, we are very hopeful. We have been able to deliver 10.5% same-store sales growth in Q3. We are hopeful that, as now consumer sentiment is further improving, this number will keep improving in the future quarters, which will bring efficiency back in the revenue as far as cost is concerned.
Adding to Gautam, this actual assets is only 67 crores, whereas this Ind AS effect is 211 crores. That's where the right of users of its capitalizing on 116 is having an effect.
Okay, so could you elaborate 116? I didn't get that part, if it is possible.
Moses, please go ahead.
Yeah, I'll do that. This 116 was introduced in 2020, which has an effect that the comparison between the companies which is operating on a lease asset model versus own asset model, they have introduced world over, and in India it is called Ind AS 116, wherein the lease rentals for the lease period is being capitalized as an asset, and then a corresponding liability is also created, and it is amortized over the period as a depreciation and interest. So there will be a interest amortization over a period of the lease period, and there is a depreciation amortization over the lease period, wherein the rental paid actually will be adjusted against the lease liability. So there won't be any rental expenditure in the line item of a P&L, whereas there will be an expenditure in the form of interest and depreciation. So this process is a very technical process where we have to calculate based on the lease life of the assets, based on the return on loan average interest, all those things. So it is a very complex working, and we have to do, and because of Ind AS 116, and because of that, I have for example, as on 31st December, we have a lease right to use assets of around 211 crore, and we have the corresponding liability also to the extent of around 200 crores. So this is a matching entry, and the balance sheet is skewed accordingly. There is no. This is what the present state is. Hope you understand what I am trying to do. If you have anything, you can.
Sure, sir. So I think that answers the question. Thanks. Thank you.
Thank you. The next question is from the line of Devanshu Bansal from Emkay Global Financial Services. Please go ahead.
Hi, congrats on a good set of numbers, and thanks for giving me the opportunity. Sir, you have alluded to it, but I want to reconfirm this. So, based on rough calculations, your annualized run rate in Q3 for revenue per square feet is about 23,000. And this number was about 17,000-18,000 in FY20. So you alluded that seasonality is not there. So was there a pent-up component here which saw demand from Q2 shifting to Q3, or this 23,000 revenue per square feet is sustainable going ahead?
Yeah, thank you. So see, I think we saw pent-up demand in Q2, Because when things started opening, I think look, the first lockdown was around June end, or it ended around July end. So in August and September, we did see a little bit of pent-up demand. But I think from a festive perspective, what we have seen, these are pure and play festive sales, what we have seen in October, November, December. And it has been very healthy for the entire industry. So I think this, the coming Q3s in the next few years, I think it's very much sustainable. We are actually going to keep growing on this.
Sure. And new stores that we have been adding are of relatively much higher size than what we have added before. So what is the average size of stores that we should expect going ahead?
See, we have not really dramatically increased those sizes. There are very few stores which have opened of larger sizes, but we are still sticking to the old model of about between 300 and 400 square feet. So our store sizing strategy has really not changed, barring of those very few stores which we have opened in a large size. But otherwise, we are sticking to the old model of 300 to 400 square feet. So today, our average size is ranging between 350 and 400 square feet, and even in the years to come, it will be in similar range of might slightly increase by say 50 or 60 square feet.
Sure. I have two bookkeeping questions. One is, have costs like rentals, employees, and advertisement normalized compared to pre-COVID levels, or they should increase in the quarters coming ahead?
Sure. So see, employee costs for us historically, if I take pre-COVID also, has been in the 12 to 13% mark. If I take for quarter 3, we are at about 11%, our employee welfare cost. As far as rentals are concerned, historically pre-COVID, if I reverse Ind AS and see rental as one line item, our rental cost has been in the 12 to 13% mark pre-COVID, and today also we are having it about 11.5 to 12%. So to a very large extent, our rental and staff welfare cost has been normalized as a percentage of revenue.
Sure. And you indicated pre-Ind AS EBITDA margins at 24%. What is the pre-Ind AS PAT number in Q3?
See, pre-Ind AS tax number would be similar to the current number. It does not really change. So there's no very big delta difference between our 23.6 crores and the pre-Ind AS PAT. It will be a very, very similar number.
Sure. And one last question. Any guidance on reduction of receivables based on lower LFS mix over the next few years?
So as we keep increasing our EBO sales, see, the absolute number of LFS receivables is not going to come down because of the SOR logic I explained. But as our EBO business keeps increasing as a percentage, and we eventually touch the 80% number or higher, receivables as an overall number will, as a percentage of total revenue will fall. So this will keep optimizing in the coming quarters.
And just to get some numbers around it, we were at 50 days. So any number that you can highlight next 3-4 years where we can reach?
It's very difficult to guesstimate that, but we will definitely see a good reduction.
Sure, sir. That's really helpful. Thanks for taking my questions.
Thank you.
Thank you. Participants, in order to ensure that the management is able to address questions from all participants, please limit your questions to 2 per participant. If you have a follow-up question, you may rejoin the queue. The next question is from the line of Anirudh Shetty from Solidarity Investment Managers. Please go ahead.
Thanks for taking my question. Sir, I'm a bit new to the business, so I had some basic questions. What was the thought process behind doing an only bottom wear, kind of business? And just to look at it from the customer's viewpoint, when they're shopping, do they prefer to have go to a store which is only bottom wear, or would they want something which has everything at one place, top wear, bottom wear? And and just for implications for us, do we plan on expanding beyond bottom wear as well in the future?
Sure. Thanks, Anirudh. Thanks, I'll answer that question. So Anirudh, see, when we started the business in 2010. When we started the business in 2010, we were trying to look at a category where there are limited number of players and where it would be easy to enter. And at that point, and it was around at that point of time when we saw that the women's market was moving from a sari market to a 2-piece separate market, where the bottom wear was a prime relevance. So in that bottom wear space, we saw that there were very few organized players, very few. So that's why we selected bottom wear as a category. not top wear. Now, when we selected bottom wear as a category, what we have now noticed is that, look, we are keeping all bottoms in our stores. Ethnic, Western, fusion, athleisure. Basically, if a lady thinks about bottom wear, she should get that bottom wear in our store. Now, customers obviously prefer buying with that range, available range. And that's why we have seen so many customers coming to our EBOs to buy bottoms, because of the range of colors and products we are giving under one roof. So that's one of our large selling points is that we collate all our bottom wear products under one roof.
And do we plan on expanding beyond bottom wear in the foreseeable future?
As of now, not Anirudh, because we have the market is very large. Today, according to our research report, the market is going to become as big as 11,000 crores by 2025. The women's branded bottom wear. The overall women's bottom wear, including unorganized, would be about 23,000 crores, but the branded wear would be about 11,000 crores. So the market is very large for us to grow. Currently, in the current market share, we only have 8%. So not only do we have an opportunity to increase the 8%, but our addressable market is going to become 11,000 crores by 2025. So we are planning to stay completely razor sharp focused on ladies bottom.
Got it. Next question was on just your SSG. If I look at it for the last few years, you have outperformed the industry and other peers as well. So what has contributed to this market share gain? And just going forward, don't want a guidance, but what is essentially a broad range of growth that one can expect, given the industry is growing, you guys are gaining share, doing well, expanding the number of stores. So what is a broad range of top line growth that one can assume that this is a reasonable growth assumption for long periods of time?
Yeah. So Anirudh, I'll tell you, the SSGs are healthy in this business because there is this bottom wear category is a very new category in women's wear, right? I mean, it's been there only for the last 15 years in terms of relevance. There is a very, very huge tailwind which we have because there is a very big shift from unorganized to organized. And because there is a very big shift from unorganized to organized, we have these tailwinds of SSGs behind us. And that is why we've had better SSGs, decent SSG compared to the entire market. Now, on a sustainable basis, we see these SSGs sustaining or improve in the future based on market sentiment. And there's a very long runway for growth as far as growth expansion is concerned every year. So at a company level, we see ourselves grow at a CAGR of more than 20% very easily for the next few years without any problem.
Got it. And just one final question. I understand there's like accounting change due to Ind AS 116, and so your return on invested capital, your margins are a bit skewed. But if I just look at your ROE, which should be not so impacted because of all of this, what is the long-term sustainable ROE that you guys think you can manage?
See, our current ROEs are very healthy. It's very healthy. It's around the 20% mark, if I'm not wrong. But I think as our EBO sales improve, as our profitability increases, it's going to further improve in the years to come.
Got it. This is very clear, sir. Thank you for taking my questions.
Thank you, Anand.
Thank you. The next question is from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for taking my question, sir, and congratulations on a good set of numbers. Sir, I am pretty new to the company to that extent, and some of my questions could be very basic, so pardon me for that. So the first question is with regards to the inventory management. You have clearly highlighted that your 97% plus sales, full price sales, and inventory management has been tech based. So if you can help out, how do we go about it a bit more in detail?
Yeah, sure, Gaurav. Gaurav, our inventory management is completely tech-based. And look, when I mean tech-based, what we do is we monitor sales on a real-time live basis. So any SKU, though our product is seasonal, we have to also keep an eye on how the product is maturing over quarters and over years. So today I'll give you an example. Previously, churidar used to outnumber and outsell leggings in the past years. Then slowly what happened over quarters and over years on a long-term horizon, churidar sales started falling a little bit and legging sales started to increase. This transition from that one product to the next product is basically done by tech. So we at a company level analyze the sales of each SKU and see it on a long-term and a short-term basis, and then see what is coming into trend and what is going out of trend. So whenever when any product sales are increasing, the inventory automatically increases at the back end. And whenever the sales of a particular product decreases, automatically the system decreases the inventory at the back end. So this, for us, everything is backward calculated from a sales approach is what we use. And that's why we are able to have our inventory under control.
Sure, sir. So I'm not very sure, but is the manufacturing done at your end or is it outsourced? I mean, how does the manufacturing process work here?
Yeah, sure, Gaurav. So our entire manufacturing is outsourced. Though we buy our own fabric, we buy fabric from suppliers, and then we give it for job work conversion to the job worker. So though we have in our inventory, you will find finished goods and raw materials, but we are not into direct manufacturing. We don't have factories or we don't have units. We buy fabric and we give it for conversion to a garment to suppliers. And there is certain percentage of sourcing what we do direct, and we buy finished goods directly as well.
Sure, sir. Just a follow-up on this then. So, in case, as you mentioned, that you find at times, that a particular product is selling higher or lower. So, for example, during this festive season, you would have definitely seen a lot of products selling a lot better than what would be an earlier expectation. So, in that case, how do you manage the production with the third-party vendors or the other players?
See, I mean, look, you can't, we like I told you, right? So we have to look at a long-term horizon. See, on short-term horizon, we really don't take such calls. We take a combination of short-term and long-term sales, and then we arrive at how we want to manage inventory at a back-end level. Just going basis of one quarter would not be the real right approach to decide.
Sure, sir. And so the last question is with regards to, while you have been doing this EBO model and it clearly seems to be profitable and contributing to the gross margin profile of yours, but, given now you are a network of around 450 odd stores as of now, and your brand is now well known across, haven't you explored the franchising model yet? Given that it could be asset light, could help you explore faster, and also, then you can gradually reduce the margins, also channel margins, given, your brand becomes popular.
Yeah. So Gaurav, see, the point is, look, we are not against the franchise model, but because we follow a cluster-based expansion model, we are able to manage our EBOs efficiently well. So, look, in our current 476 stores, we have 11 franchises. So it's not that we are against that model, but because we followed a cluster-based expansion model, that cluster-based expansion model gives us the liberty to manage those stores directly. And that's why even in the coming years, we are going to cities where we can open more number of stores in one territory rather than spreading ourselves thin. So we would like to, and because our return on investment is pretty decent in our EBO model, we would rather enjoy the channel margin by opening by doing the FOCO store, by company-owned operated store.
Sure, sir, I get it. Thank you for answering my question.
Thank you, Gaurav.
Thank you. The next question is from the line of Ankit Kedia from Phillip Capital. Please go ahead.
Sir, thank you for taking my questions. So my first question is on your SSG growth. In last 9 months, we have a ASP increase of around 11%. Is it fair to assume our volume SSG over pre-COVID would have been negative growth? And broadly, the SSG is on back of price increases we have seen in the system?
So Ankit, our volume SSGs are about 1.5% to 2%. If I compare, 9 months is not comparable because of different lockdowns. But if I compare at pre-COVID levels where we are generating 10.5% of same-store sales growth compared to pre-COVID, we would have had a volume same-store sales growth of about 2%.
Sure. So going forward, because of the aggressive EBO expansion, the SSG which you are targeting double digit would come purely from price increases in future as well, or we're talking of some volume growth as well, factoring that in the numbers.
No. See for us, Ankit, our price increasing happens because of our new products. We, as such, as a company, don't increase the pricing of a current product portfolio every year. We don't do that. We do it only if there are long-term cost increases. Otherwise, we really don't touch the pricing of a product. But yes, our ASPs have increased because of newer products coming in which are of slightly higher selling price. So the future SSG is going to be a combination of new products as well as volume growth. It's going to be a blend of both.
And are you comfortable with more stores in the same city, or do you think the new stores are cannibalizing the old stores and hence you are seeing a low single-digit kind of a volume growth SSG?
See, that's a good question, Ankit. I'll tell you, we are currently in a state where we are looking at same-store sales growth, where most of our stores are growing very well year on year. But see, what will happen is, today, for example, if I open more number of stores in one territory, I will look at, instead of looking same-store sales growth, I will look at same area sales growth of that one territory and how many stores I have, combine the rental and employee cost, and then make a P&L of that one area and then calculate same-store sales growth. See, then what happens is, today we have not reached a situation where our stores are getting cannibalized, because like I told you, there's a very big shift from unorganized to organized, right? So we are currently not seeing cannibalization. But tomorrow, when we open more and more stores in one vicinity, a few stores will definitely get cannibalized. But then the right way of looking at it would be looking at same area sales growth of that vicinity, adding up the rental and employee cost of that entire vicinity, and then calculating the EBITDA for that particular area.
Sure. So you're comfortable with the low single-digit volume growth? SSG growth.
It's not about comfortable. We see that this volume growth also will further improve. See, right now, things are coming back to normalcy after COVID. Sales are going to keep coming back. This volume growth also will, in its own way, keep increasing.
Sure. So my second question is on your cash flows. Can you talk of first 9 months pre-Ind AS cash flow from operations or post-tax? Because the number which you have shared in the presentation is post-Ind AS cash flow. Can we get a pre-Ind AS cash flow from operations if possible?
Yeah, sure, Ankit. See, for us, if I take pre-Ind AS cash flow, we have a negative cash flow from. I'll just tell you 1 second. Yeah. See, if I take, we have a negative cash flow of about 39 crores of free cash, negative free cash, because our inventory has increased, our working capital has increased by about 66 crores. And because of the lockdown, so we have a negative cash flow post-tax and after investments. After the stores we have added, our negative free cash is standing at about 39.64 crores.
Sure. And sir, you mentioned on the price increases, which you take is only if you see a significant RM inflation. So currently speaking, given that RM prices continue to increase, and also in Tirupur where we do our manufacturing, the industry out there is also asking for higher job work rates. Do you think our current price, the 50 rupees which you are taking an increase in the month of June, we are comfortable with that, and next 6 months we don't need to take a price increase?
No, we have whatever price increase we have taken in the last 6 months, Ankit, we are pretty comfortable with that. We don't see a problem.
Sorry to interrupt, Mr. Ankit. I request you to please rejoin the queue.
Ankit, just one clarification. I made a mistake. The cash flow from operations after pre-Ind AS is at negative 25 crores.
Sure, and not 39 crores.
Yeah, it's negative 25 crores pre-Ind AS cash flow from operations.
Sure. Thank you so much and all the best.
Yeah, thank you.
Thank you. The next question is from the line of Aditya Sharma from Ambit Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. I think I missed if you have earlier shared the quantum of price hikes that we have taken.
Yeah. So we have taken some price hikes in March and April, where we had increased certain products. We had increased the product pricing by 50 rupees, and certain products we have also increased it in the month of December end, based on the raw material prices which had gone up.
Okay. I was just trying to get some assessment in terms of what would be the contribution of product mix and the price increase. If you could separate that for us, would be really helpful.
So right now, if I take the bifurcation, so our average selling price is about 650 rupees. Very little is come from the new product, so from the new price, because the inventory which is there at the store end always keeps selling at the old price. When we change the pricing of any current product, only the new production and the new pieces which go into the store level sell at the new price. So largely, I would say this increase in average selling price is driven by the new products and not by the price increase which has happened for Q3.
Got it. Sir. Very helpful. My second question is you talked about the rent and the employee cost is largely as a percentage of sales. So just wanted to understand as a retailer what contribution at some level would be variable for these costs and how much of it would be fixed, because there are different ways of operating in retail, right?
For us, largely both these line items, which is employee costs and rental costs, are fixed. Because there are some malls which have a revenue share arrangement, but all those malls also work on a fixed MG, on a fixed rent, and high streets are all fixed rentals. So for us, as far as rent and salaries are concerned, these are fixed in nature, and so that's why in Q1 when we had the specific lockdown, the company incurred a loss because of these two line items being fixed in nature.
Got it. Just one final question. So according, looking at your financials, we are already at a very good margin level. And as our gross margins improve with the increasing mix in the EBO, I think we'll reach a very high margin level and probably invite a lot of competition in apparel market, which is anyways a very difficult market to operate. So I'm just trying to understand, are we looking at to come back, to give back some of the margins back to the customers so that we can keep our offerings more sharp?
So look, we like I mentioned, when we do a price increase, I'll give you an example. Whenever there are short-term fluctuations in pricing, we actually don't increase our prices because we understand that these are short-term fluctuations. But when there are long-term increase in cost of goods sold in terms of sourcing, that is when we increase the price. So once we increase the price, we really don't decrease it, and we are very careful when we are increasing the price, so that we should not be in a situation where there is a situation to decrease.
Okay. Thank you.
Thank you. The next question is from the line of Naitik Modi from OHM Portfolio. Please go ahead.
Yeah, hi. Thanks for the opportunity. Coming back to the working capital, could you spend some time on looking at various components and how do you intend to reduce the overall working capital cycle?
Yeah, sure. So currently our working capital is about 170 days as on for the 9 months fiscal 22, and pre-COVID we were at about 150 days. This is largely the 20 days have largely increased because of inventory days. We have higher inventory than what we were maintaining before, but this number is looking higher in terms of days because we had a lockdown this current year. On a steady state basis, we see our inventory days, which are currently at about 120-130 days, coming down to about 90 to 100, within that range. And our receivable days, what are at about 50 days right now. As our EBO sales increases, that 50 days number also would keep coming down. So on a long-term basis, we would be able to bring this to about 120 to 125 days of working capital days on a long-term basis. With the EBO sales increasing and the debtor days falling, and we bringing down the inventory days to about 90 to 100, which has been a past number.
So 120 days is more like a sustainable number.
120 to 125 days is the number which we are going to be targeting on a long-term basis to achieve, which is currently at 170.
Right. Secondly, on the EBO side, what is the breakup of Capex and the inventory investment?
Sure. So out of the 35 lakhs, the Capex would be about 15 lakhs. The inventory would be about 10 to 12 lakhs, and the balance would be security deposit, which is refundable from the landlord.
Okay. And what is the incremental rental per square feet that you are setting up the new stores?
Incremental rental? Sorry, I didn't understand.
Incremental rent per square feet.
As in incremental rent per square feet for a new store?
Setting up, what is the rent per square feet for that store?
Usually what we do is, when we are taking a store, because our store sizes are small, the rent per square feet will vary from town to town, from city to city, and from zone to zone. we usually look at a rent to revenue ratio of about 15 to 16%. That is the range what we look at when we sign a store. So actually what we do is first we estimate what is going to be the revenue of that particular store, and then we see what is going to be a rent to revenue ratio, and then see whether the store is feasible for us to do. On a per square feet basis, it becomes hard to quantify because each zone, each city has different square feet rates for such small sizes. It's not consistent.
Sure. And could you share the volume numbers quarterly, annually, whatever you can share?
See, we have for the 9 months fiscal year 22, we've had a very healthy volume growth of about 25%.
Right. No, I meant more in absolute numbers.
Sorry, absolute numbers, I don't have it right now with me. But as a percentage, we've seen volume growth of about 25% over last year.
Sure. Just a suggestion, if you could add it in your presentation, it will be helpful.
Sure. Point. We will take note of that.
Thank you very much, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Himanshu Nair from Yes Securities. Please go ahead.
Good afternoon, sir, and thanks for taking my question. So, just wanted to understand on the investment front. So, you said you are going to invest aggressively on the omni-channel and digital capabilities, and I believe with such a fast pace of expansion, you might be needing more warehousing space as well. So, on these two areas, have you formalized the sort of investments that you need to make over the next 2 to 3 years?
Yeah, see, what we are doing currently, we are working currently on a single warehouse model, and the single warehouse model is working very well for us. So there might be, currently our current warehouse is very well equipped to handle our future growth without any problem. We had moved into the new warehouse only in 2018. So a large part of our future growth can be taken care by the current premises. But having said that, tomorrow if there is a need in our current warehouse also, we have place to expand. So as the business keeps increasing, we will be very open to expanding our current warehouse space where we are currently present without any challenge. For us, a single hub distribution point works better than regional, and we want to stick to that model.
Okay, got it. And on the omni-channel side, any specific technology investments or any significant Capex other than the normal one that we need to sort of look at?
See, on an omni-channel, what we are trying to do is we are trying to integrate our entire EBO channel with our digital channel. So today, what we are trying to create is a customer should have a 360-degree view of what she's buying from Go Colors or any other brand, right? So today, if she buys online, she should be able to pick up the piece from the store. She's at the store level, not found what she wants. Then the piece can get delivered at her house as an online order. So I'm saying online or physical buying or exchange or return should be seamless through an omni-channel for a customer. And that is what we are trying to do by integrating our EBO channel with our digital channel. And the investment in this particular line is not going to be very large because there are many good solutions available in the market for this integration.
Good. So any number you can share, how many of our stores are already offering this, or this is still work in progress?
This is still work in progress. This is under development, and we are hopeful that in the next few quarters we should take this line in a paced manner.
Got it. Thank you. That's all from me, and all the best to you.
Thank you so much. Yeah.
Thank you. The next question is from the line of Binoy Jariwala from Sunidhi Securities and Finance Limited. Please go ahead.
Yeah, thank you for the opportunity.
Could
you explain? Yeah, hi. Could you explain me when you set up an EBO, typically how many months of sale you keep as inventory?
So Binoy, see, this is a very difficult question to answer, and I'll tell you why. It depends on the sales of the store, and it depends on the square feet. See, sometimes what happens is because you have a particular size of a store, even though your sales of that particular store is on the lower side, but you can't keep a particular shelf empty in a particular store. So in some stores you have to maintain 6 months of inventory. There are some stores in which if you just, because of the sales being on the higher side, you can maintain even 1 month of inventory. So your inventory stocking in that particular store comes down to what is your actual square feet and what is going to be your revenue. See,
So
for a lower performing store, it's not easy for me to cut down the inventory based on the inventory mapping.
Okay. So put it differently, let's say, what would be the inventory per square feet that you typically
So I'll answer this in a slightly different way. Yeah, I'll answer it in a slightly different way. Usually we maintain about 2 to 2.5 months of inventory on sale at a particular EBO on an average.
Understood. And, what would be our, of course, we have you're about 95%, 97% of sales is full price sales. So, inventory write-off and shrinkage should not be a problem. But, for the accounting purpose, typically, what is our inventory write-off policy and what is the typical shrinkage that we have?
Yeah, sure. For example, our shrinkage is very negligible because we do stock audits on a quarterly basis at all our EBOs. So it is a very, very negligible amount. It is less than 1 million rupees. It's less than 10 lakhs in terms of quantum rupees a year. In terms of write-off policy, yes, our inventory is non-seasonal. There's no seasonality to our inventory, but we have a write-off policy. So any inventory at our warehouse which is more than 365 days old, our finished goods, we do a provisioning on that. And similarly, for any inventory which is there at our store level which is more than 550 days old, we also provide for that. So we have an inventory provisioning policy in place which we use for bookkeeping.
So you fully provide or 50%? What is the?
No, it depends. We usually provide at the market rate. At what rate it can sell. So we provide it on that basis. That of cost, whichever is lower.
Cost or market only, whichever is lower. That's what.
Yeah.
Okay. Understood. Okay. Now, we're a fairly new company, right? So, have we undertaken any refurbishment of the existing store network, or what do you think? If not, we've not taken, then what is the typical refurbishment cycle for the store?
See, this is a good question. See, for us, because of the nature of our product, it does not really, because if you see our stores, we are fairly very simple with racking. So it looks, from a refurbishment perspective, many of our stores which are greater than 4 years and 5 years also have not come under renovation, frankly. But yes, there are some situations where we are relocating from one location to the other location on the same road for the better visibility of a store or for better operating metrics. So there are certain cases where we do replacements. We move from one location to the other nearby location or better visibility location. But our number of stores which we renovate for creating more space in the existing spaces is not very large because of the type of product we have. See, most of our products are folded and kept. So there's really no need for us to renovate our stores beyond the point. We do small mini partial renovations if there is any problem with our lighting or air conditioning or with the fixtures we have, but there's no major renovation required because of the nature of our product.
Sorry to interrupt. May I request Mr. Binoy to please rejoin the queue? We have participants waiting for their turn.
Sure.
Thank you. The next question is from the line of Akhil from Centrum. Please go ahead.
Hi, thanks for the opportunity. My first question.
Sorry to interrupt you, Mr. Akhil, but your voice is sounding really low. Can you please speak a bit louder?
Is it better?
Yes, please go ahead.
Okay. My first question is on the ASP trend. How is it different in tier 2, tier 3 towns versus our top 8 cities? The question is in regards to whether the customers really have a propensity to spend 650 rupees on the bottom wear in tier 2, tier 3.
Sure. So we have seen very consistent ASP even tier 2, tier 3 versus tier 1. See, I tell you, the reason is majority of our products we are pricing at less than 1,000. More than 70 to 75% of our products are less than 1,000. And because of this reasonable pricing of keeping it under 1,000, we have seen that our ASPs between a tier 3 and a tier 1 have been fairly similar. So we have not seen big disparity between the two.
Okay. Fair. And second, on repeat customers, do you maintain data point on what percentage of our sales come from our repeat customers?
Yeah. So we do math, and we've seen that more than 40 to 50% of our customers are repeat customers.
And last question on the footfall growth or decline and conversion rate compared to 9 months of FY20.
Compared to 9 months of FY20.
Yeah.
Yeah. See, in fact, I'll give you an example. After COVID, we've seen actually conversion rates actually slightly improving. We've seen a lot of customers coming and buying a lot more at one time than what it was before. So conversions are definitely, if not same, but actually improved compared to fiscal year 20.
Okay.
And footfalls is, as far as footfalls is concerned, we right now currently don't track footfalls. We don't have a current solution to see how many footfalls or walk-ins we have. We are thinking about a software where we can map footfalls, but currently we don't have a real concrete data around how many footfalls we receive in a day. We don't have that accurate data.
Oh, that's all from my side, and wish me best luck for the coming year.
Thank you.
Thank you. The next question is from the line of Anirudh Shetty from Solidarity Investment Managers. Please go ahead.
Thanks for the follow-up. My first question was on brand building strategy. Wanted to know what's the thought process behind having one kind of mother brand instead of having multiple sub brands, and typically what does this translate into a sustainable A&P spend as a percentage of sales for you guys?
So thanks. So I'll explain a little bit of that, Anirudh. So see, as far as advertising, so I'll come to the brand part second. I'll talk about the advertising and marketing spend. See, for us, there are two types of advertising, right? You do offline advertising and you do digital advertising. There are two broad buckets of advertising and marketing. Now, as far as our offline physical advertising is concerned, the entire advertising is taken care by our EBOs. See, our EBOs, we locate our EBOs in very high footfall zones, in good malls, in airports, where a lot of customer eyeballs are caught. So a lot of our advertising is indirectly done through our EBO in the offline world. So in the offline world, we really don't have to take hoardings or bus shelters in a very large way to communicate our message. Now, as far as on digital advertising is concerned, digital advertising is a huge medium for advertising, where we feel a lot of our customers are spending a lot of time on social media. Today, social media and digital advertising is a new age of advertising. So we are, building our team. As we increase our digital advertising, our digital sales also will increase. So we see, because we are largely going to be digital in terms of advertising, our spends are going to be about up to between 2 and 3% of our revenue on a steady state basis, and not increase more than that.
Got it.
And coming back to the brand, we don't really have any plans to do brand extension. See, for us, we have created one power brand in the name of Go Colors, where we are giving high quality products at reasonable prices, so we are able to reach out to the entire audience in the country. So rather than bringing out brand extension, we feel that keeping one brand, the recall of the brand also will be far better.
Got it. This is clear. The second question was on the online business. We want to take the share up from 2-3% to double digits. So can you just break it up into what do we expect to do through our own proprietary channels vis-a-vis third party aggregators, and how does the economics for online compare vis-a-vis our other channels like EBO and all?
Sure, Anirudh. So Anirudh, currently 2/3 of our online revenue comes from marketplaces, and 1/3 of our revenue comes from our own website. What will eventually happen is, once we improve our website, this ratio should become a 50-50 ratio. So we feel even when this becomes a double-digit number, we feel that 50% of our revenues will come from our own website, and the balance half would come from reputed marketplaces. Now, from an operating margins perspective, currently we are seeing that our operating margins in our online versus an EBO are similar. But it's too early to say, because it's only 2.5% of our business currently, right? So as we get to double digits, then we will know really the steady state margins of this particular channel. Currently, it is on par with the EBO channel as far as profitability is concerned.
And from a working capital perspective?
See, from a working capital perspective, the working capital is fairly light. It would be similar to working capital for an EBO, and I'll explain to you why. In EBO, you have inventory days and you don't have receivable days, but in online you have receivable days but don't have inventory days. So it's fairly, I would say it's fairly similar between an EBO and an online as far as working capital is concerned.
Sorry to interrupt. May I request Mr. Anirudh Shetty to please rejoin the queue?
Sure.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, thanks for the follow-up. Just wanted to know what will be store shutdown number and company's lifetime so far?
See, if I take the overall, it would be under 50 stores, Tejas. And most of these 50 stores have come in the last 2 years because post-COVID, there are some areas, some locations which have not recovered post-COVID. Let me put it that way. But in the life history, if I take of stores, it would be under 50 stores.
Sure. And what would be the primary reason apart from COVID for shutdowns?
I would say there were some stores which were doing average revenue, but revenue has fallen post-COVID. There are some stores where the rental cost was exorbitantly high, but pre-COVID, those stores, because of the revenue it was generating, they were able to steady state sustain. So those revenues have fallen. So if I had to single out, the main reason is drop in revenue in those stores.
Sure. And then last one, you spoke about the understanding with LFS that we have, and at the other end, the pricing discipline and then the no USS discipline that we follow. Usually we have seen that kind of pricing control or pricing parity is possible only when you are running EBOs. Because LFS, for example, if Reliance Retail or Trend goes on a discount or end of season sale, do you not participate in that format in EOSS, or how do you manage parity in that kind of scenario?
Yeah, very good question, Tejas. I'll explain to this. So look, see, in a LFS, there are two types of discounts, right? One is the discount what you give on your product if you decide to give, and the other is LFS running their schemes and promotions, right? So in our product, we don't give too much of discounts because, like I told you, our product is not seasonal. But having said that, LFS do run their schemes. But when LFS is running schemes and discounts and promotions, the discount is not at a product level, but it is at a basket level. I'll give you an example. If today one of the LFS is running, saying buy 3, get 25% off on the basket, that basket is not only for me, but it also means that the overall purchase of a customer in the large format store. It can be, if she's buying 2 pieces of another brand and 1 piece of mine, she gets the discount. So that's more on the basket level and not at a product level. At a product level, there is no disparity between the price what I'm selling in a LFS versus an EBO.
Fair point. Very, very detailed. Thanks for that and all the best.
Thank you, Devi.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you. So thank you everyone for joining us. I hope we've been able to answer all your queries. We look forward to such interactions in the future. Once again, I would like to thank the investor community for the tremendous support shown during the IPO. We hope to live up to the expectations of you all in the future. In case you require any further details, you may contact Mr. Devendra Ruva from SGA, our investor relations partner. Thank you. Take care.
Thank you.
Thank you.